Hello, hello, hello. Thank you for being here today and joining it for yet another live event where we unpack key steps of the underwriting process one step at a time. Appreciate you being here today. And for those who don't know me, my name is Vessi Kapulian. I'm a former commercial lender turned real estate investor. And today I help high achieving professionals, family offices, investors essentially diversify their portfolios into commercial real estate, specifically well vetted cash flowing apartments. And I also help investors new to multifamily learn how to analyze deals from beginning to end so they can minimize the risk of loss and protect their capital. So, today I thought I would cover a topic I've been getting a lot of questions about from a prior live event as well as a recent newsletter that I published on LinkedIn. And specifically, what I'm referring to is the deal review that I help investors with. So, comment deal if you're excited to learn more about the case studies that I will be sharing with you today. Type deal in the chat, and there's some lag time before I see the comments, but it will also allow me to connect with you better. And of course, if you have any questions as we come along, I will reserve a little bit of time in the end to address those. But you're also welcome to DM me or connect with me directly, and we can chat offline. But before we dive in, I guess the first item that I want to clarify is what is the deal review? Effectively, that's me providing a second set of eyes on a deal underwrite, doing the assumption review. I share a detailed summary report with you, and then we have a 30-minute session to go through the findings of the report as well as address your burning questions. So this is ideal for passive investors who need and want that additional or third-party second set of eyes, or for capital allocators who are potentially looking to join a team or joining a deal and would like that objective third-party review of the investment. Now, I do have an underwriting community that also comes with a self-paced course. So if you'd like to learn more about that, you can simply send me a DM. But some investors are more limited on time. Some don't have the not only the time but the desire to really learn underwriting from A to Z. So this particular review was really developed for those who need more of a one-off deal review as investments come along, or perhaps are a little bit more pressed on time, have time-sensitive deals that they would like to decision, and don't necessarily have the time to invest, like I said, to learn the full underwriting process. And why is it important? Because very often, right, when we're presented with information, that information comes from the sponsor, and I find way too many investors, active or passive, relying on the sponsor's material or surface level reviews and feedback from other investors who may or may not necessarily have the same experience level. And at the same time, you have a lot of money on the line, whether that's your own capital. And for most of these deals, the minimums start at 50 to 100,000, and very often people invest even more. Or if you happen to be a capital allocator, you likely have millions on the line by virtue of not only your own capital that you're putting in the deal, but also that of your investors. So hopefully that provides more clarity on what that is, who this is for, and why it's important. And without further ado, I'd like to dive into two real life case studies that I've recently actually gone through. The first one being with a passive investor who unfortunately got the dreaded capital call notice. And I've been helping with that quite a bit over the past few months. Regrettably, a lot of deals are going through the stress. And so in that particular case, they got the notice. They had a very limited time to make a decision whether to contribute or not. Now, the sponsor had issued the capital call warning that without that additional investment, their original capital is at risk. So they were feeling quite pressured, and that's when they reached out to seek that objective third party set of eyes, so to speak. So we reviewed the deal with the information that was presented to them, and there were a few red flags that emerged. First of all, the way the assumptions were structured assumed, right, or projected that the cap rate for that particular market will compress pretty materially over a relatively short period of time. And by virtue of that cap rate compression alone, the exit valuation was pretty substantially elevated. Apart from that, as we peeled the onion on the NOI assumptions, there were certain projections made with respect to the rent growth, and in that particular market is going through rent declines at the moment. So to be projecting rent growth in the first year or even second year of operations when actuals are declining is also very optimistic. And so effectively, the message from the sponsor was invest now or else you lose your capital. Otherwise, you actually have the potential to save your entire principal over that time horizon that they were presented with. But in reality, what the analysis revealed is if those assumptions do not materialize, and mind you, a lot of things will need to go not only right, but effectively the entire market needs to shift in the next month or two for those projections to materialize. Then they were looking at potentially losing their capital 3-4 years from now when that projected time horizon was presented to them. So effectively, it really reframed the situation, and the decision they had to make or were faced with was either contribute more capital now, so you end up pretty much in the same situation, i.e. potential loss of the entire or nearly entire capital, say 3 years from now, or save your money and invest it in a deal that's actually performing and doing well. There were a few other, I don't want to say necessarily red flags, but maybe pink flags. So for example, part of the capital call proceeds were going to be used to entirely pay off a shareholder loan that that particular sponsor had made. So essentially reducing their skin in the game for that particular situation, which raises a whole other set of questions. And so ultimately, the client decided not to contribute the additional funds, and as a result, they avoided further potential losses. But most importantly, they gained a renewed sense of confidence in their decision making. I applaud them because they sought help, they asked the hard questions, and ultimately prioritize clarity over pressure, making an informed decision versus being pressured and solely relying on that other party's messaging, words, and information. Now, the second case study is actually with a capital allocator. And so they were presented with a multifamily investment opportunity. That one in particular had a slightly heavier value add component, so not your traditional middle of the run stable value add multifamily. And it was with a sponsor that was new to my client. So not necessarily a sponsor new to operations, but a sponsor new to my client. And even though the deal looked very promising on paper, the complexity of the business plan coupled with the relatively new nature of the relationship prompted them to reach out to me and seek a deeper review. And so we reviewed the information very carefully, and there are a couple of things that stood out. Again, I'm not giving you the full list of items that emerged, but just hitting on a few key ones. One pertains to the rent growth assumptions, which were somewhat aggressive relative to the historical rent growth run rate for that particular market. And then the other one pertained to the stabilization period, which effectively assumed that everything needs to go exactly right. No delays in rehab, no cost variances. I mean, zero variance from projections. And so when we tweak the numbers just a little bit to say, what if there is a delay of X days, or maybe we don't rehab X number of units, but we rehab less, or maybe rents don't grow as high as projected, the deal turned from the um, mid-tier double-digit returns, like it was in the 30s, to pretty much negative. And so that really illustrated the point, and one I often make, is that a lot of investors think in the realm of high risk, high return, and that's all good, yes, because you have to be compensated more for taking on more risk. But higher risk, higher return also means higher probability of loss. And this was a case that illustrated that, because just a little change in the business plan execution actually would have resulted in negative return. In other words, loss of capital and investment loss. And so we walked through the numbers and a few other considerations. There was a pref equity tranche, and generally speaking, I don't have anything against pref equity. There is a time and place for that. But in this particular case, as you can imagine, since this was a heavier value add deal, the cash flow was pretty much none, right, in the first 2 years of operations, and very slim thereafter. And so what a lot of the capital was raised for is to effectively cover the pref equity payments, the current pay required by the pref equity provider, and as well as the acquisition and transaction costs. So LPs, or the passive investors, were effectively being asked to carry and front a lot of that risk of the deal, which again, commensurate to the returns, didn't seem quite right. And so long story short, that particular client decided to pause on the deal, and one comment they made is that this is the best diligence money they've ever spent. So they really appreciated the clear, objective insights, as well as the ability to walk them through the very complex and detailed information in a methodical manner, and illustrate to them the different scenarios and the sensitivity of the project. So hopefully that helps provide you with the clarity that I know some of you have been reaching out about and seeking. And again, these are just a couple of examples, real life examples that I thought I would share with you, so you can get an idea of who this is for. Again, typically either capital allocators or passive investors. What are some of the findings and maybe the typical work involved, what you can expect from the process, but most importantly, why does it matter? And ultimately it boils down to a concept that I often mention, right? It's measure twice, cut once, and trust but verify. In other words, validate the information that is being presented to you. And sometimes when you're either excited about the deal or perhaps under stress and time pressure, it's often difficult to manage the objectivity, which is where having a third-party set of eyes can come in very handy. So that's all I have for you today. Let me see what questions you have. And again, I know there's usually a bit of a lag in the chat. All right, so how long does the process typically take? So it depends, right? It depends on the deal. I offer standard review. There is also a rushed option, so really to depend on your situation. And I can also do a deeper dive to go through some of the additional documents that come with the deal, additional third-party diligence of the operator. So it really depends on what your specific needs are. Typically, we'll have a intro call or discovery call for me to better assess, understand the situation, understand your needs, understand your timelines, and then we'll work from there accordingly. Is there a report? Yes. So I'll prepare a brief written report for you to take away and reference as you digest the information and look to make a decision. Sometimes the decision is very obvious. In other case, you may need to or want to take time to think about it, but we're going to go through the results and walk through the report together. In other words, I don't just email you something and then you never hear from me. So there's dialogue before. We'll clearly agree on timelines. You get the report and then we'll communicate after, so you can walk away with the clarity you need. So, well, I appreciate you being here today. If you'd like to learn more, you can connect with me on LinkedIn or follow me also on YouTube. If you'd like to connect about the deal review, I currently have limited capacity because, again, these are one-on-one reviews, not necessarily large group cases, and they're highly tailored and customized to the client's needs and timelines. So I have limited capacity. Currently, I can take on 3 more before the end of this month, and then I'll reopen it further at a later point. And you're welcome to just message me deal review and we'll connect from there. And for future live events, which I plan on continuing to do, follow me on LinkedIn or YouTube, and I'll see you at the next one. Have a blessed day. Ciao.